likely to be a largely stable quarter coming in from HDFC Ltd. The results are expected tomorrow, which is 7th of May. In fact, the ET-Now poll estimates the profits to be fairly strong at 2,900 crore. This is a jump of close to around 30%, also coming in on the back of a low base. Profit should be supported by an NII growth of close to around 6% and also a dividend income during the quarter of nearly around 110 crore. We should also be seeing fairly controlled provisions, as the management has already stated that they do hold a good amount of excess provisions. In fact, the total provisions that HDFC has is close to around 12,300 crore versus the regulatory requirement of 6,600 crore as per the last management update. The loan growth is likely to be fairly strong, anywhere around 11 to 12% is what the analysts are pegging, and this would be on the back of a strong momentum, especially in the individual loan growth segment. Management had already taken a conscious call to go very slow on the non-individual loan growth segment. Margins should be largely stable with a slight downward bias, as we have seen a good amount of competitive pricing there, and the home loan yields have also fallen, and hence a slight downward bias to the margins. Largely, we should be seeing a stable asset quality. Q4 GNPAs are likely to be stable or maybe even below the proforma GNPA of 1.9% as seen in the last quarter. In fact, management commentary would be fairly important, especially the impact of the COVID wave 2 on the disbursements, as well as in terms of the asset quality, both on the individual loan segment as well as the non-individual loan segment should be fairly important, and also the overall commentary in terms of the recovery trends and disbursements trends. In the last quarter, management had stated that they had taken a conscious call to go slow on the non-individual loan book, and fortunately, at least till the last quarter, they had not seen a very significant rise in terms of the NPAs due to the COVID, and they had been also fairly proactive to make good amount of provisions for COVID related stress, which, as I said, they have close to around 12,300 crore worth of provisions. They also had stated that growth from Maharashtra branches for them has been fairly strong, and they are also seeing good amount of growth coming in the upper income segment. So overall, yes, the commentary from the management would be fairly important. If you look at the stock is down nearly around 5% on a YTD basis, and if in terms of the valuation, it trades at close to around 3.5x FY23 price to book as per the analyst consensus, and most of the analysts do have a target price of anywhere around 3,000 rupees per share to close to around 3,200 rupees per share. This